All right. Well, we've done a number of corporate updates here in the last couple days at the Boca Raton Rick Rule Investment Symposium for Natural Resources. We're going to step into the big picture thing, probably diving a lot into the macro and the meetings. What's happening with gold here in the short term, because there is some volatility on the charts. It's been a while since we've welcomed in my brother from the Bayou, Mr. Brien Lundin, and the host of the New Orleans Investment Conference, which I don't think he understands. Corey Fleck and I are going to roll in hot to New Orleans this year.
I think New Orleans will be prepared for you.
You think so?
Yeah,
I don't
Trevor.
know, Brian.
I think
Corey
it's good and ready.
Corey and I sharing a media tail, Clear Commodity Network.
I think I have to give you the warning that I give some people, and that is that we do not have bail money for you.
Well, my wife will be attending with me, so I think
she'll bring the bail money.
Well,
okay.
If she can't do it, if she can't keep me out of trouble, there's no.
I'll give her directions to central lockup. Okay.
Very good. How are you? It's been a while.
It's been great. It's a bull market. It is a bull market with our first big correction, our first big dip. One of the things I'm going to show the audience in my presentation tomorrow is the chart of the XAU index from 2000 to 2011. And that shows that this kind of volatility that we've been experiencing is part and parcel of a bull market. It's to be expected. Mm-hmm. We've been very fortunate in this bull market because the first 18 months or so were driven by central bank buying. And everyone, and retail investors, Western traders, everybody was standing aside in amazement at what was going on. And we didn't have the kind of correction that would be typical in that kind of a run. Now we've got Western investors in. They came in last summer, late last summer, when Powell signaled rate cuts. And we're getting, what you get in that kind of a market. These kinds of pullbacks that test your convictions, test your theses. And you have to get past this and keep your eye on the long term.
Yeah. Maybe let's talk about the price action in gold here. Mm-hmm. We're not in the clear yet. It feels like $4,000 is a nice floor here, but the chart really has not confirmed a higher low or any sort of meaningfully move higher. We've had a bounce, but we haven't made a higher high by any means, nor have we made a higher low. So we're kind of in just wait and see here. But we're also talking on a day, Wednesday, our friend Peter Bookvar just published a note. Sounds like the 10-year auction was pretty positive today, but we're still seeing long end of the curves higher today.
Yeah.
We know that is a headwind for precious metals. But maybe we live in an environment where we got to start figuring out how to get used to higher yields. We can't live in a ZERP society forever, right? Or maybe we can, and we just feel the backlash later.
That's the conundrum that we're facing right now. And Peter actually had a piece out today that we talked about earlier where he talked about 10-year yields higher right now in the U.S. The 10-year Treasury yield is about where it was at the peak of the uncertainty in the Iran war, yet oil prices lower. So the yields aren't necessarily higher because of inflation fears. 10-year yields are higher in Japan and reaching multi-year heights in Japan, in France, elsewhere in developed economies. So his point, and I completely agree with him so much that I stole his charts from my presentation tomorrow. Please remind me to give full credit. That debts and deficits are starting to matter, and that underlying everything else, underlying the war premium and war concerns, inflation concerns, underlying the suddenly hawkish Fed concerns, is the long-term issue of debt and deficits on trajectories that are unmanageable with interest rates at current levels. So interest rates have to go lower or the whole house of cards falls apart. Yet interest rates should actually rise, or that investors, bond vigilantes, if you will look at that and say, well, we demand higher yields. So what happens when you have much of the market demanding higher yields? You have sovereigns that cannot manage their debt loads at higher yields and are forcing it lower. That's the problem that we're going to face. And how that gets resolved, I'm not smart enough to figure out. There are a lot of people who will give predictions. I just know you're going to want to own gold, silver, commodities in general, and the companies that make money off of those.
We have to get to a point where gold maybe decouples from that negative correlation it has with rates. I mean, we've just seen it all year. As rates go higher, gold gets sold, goes down.
Yeah.
And that's typical of the case. It's probably the algos pushing it down. That's typically what we see. But there's got to come a point where something happens where it's like, okay, gold needs to go higher.
Yeah.
Because where else are they heading to? If it's if they're selling yields, moving to a dollar, strengthens the dollar, weakens gold, that's fine. But then we keep talking about, well, what does that mean for this quote unquote debasement trade that's been in front of us? I mean, I'm just kind of throwing out general thoughts there, but I just kind of feels like that negative correlation needs to happen, needs to break. And I don't know how that breaks.
Well, it is interesting in that respect. There's been gold and U.S. stock market have been, for a good part of the war concerns, they've been strongly positively correlated. Gold and oil have been strongly inversely correlated. Then those correlations broke as oil went up, gold went down, stock market went up, gold went down. The one correlation that has been maintained is that inverse correlation with Treasury yields. And at some point, you're right, that higher yields are going to be a bullish sign for gold. And in fact, I would argue that those higher yields have been bullish for gold, and that it's helped prompt central bank buying all along. But the central bank buying drove that market for the first 18 months, and now it's supporting the market. Right now, since then, we've had a lot of the Western investors looking at potentially easing on the Fed. That drove some rallies, but we got that kind of volatility. The Western traders and investors are in charge of the price for gold right now.
Yeah.
They're lumping it in with the risk assets. China and Asia are taking the price, and they're happy to do it at these discounts. But I don't see that lasting really much longer.
Yeah. Let's talk about monetary policy. Kevin Warsh, first month in his seat as chairman. First impressions after his first presser. I guess the notes are supposed to be released today. Maybe we can get a little insight.
Yeah, I think literally as we're speaking, or within a few minutes, they're going to be the minutes are going to be released. I haven't checked the market to see what the reactions are, but what you have in Warsh is somebody who wants to leave a mark on the institution.
But don't they all say that, Brien?
The
first 2 months, the honeymoon period.
I think Powell tried to keep things going. Powell actually was not as bad as a lot of people indicated, but Powell's problem is that Powell wanted to be Volcker, and he just doesn't have the toolbox. Nobody has a toolbox any longer. What Warsh seems like he's wants to do is to kind of redefine the toolbox. He wants to redefine inflation. He wants to bring in these productivity gains and look at and find some way to use economic growth and productivity increases, real or foreseen, to impact or moderate the inflation numbers. He's going to do what they did a couple of times before over the decades and rejigger the CPI. So today's reporting of the CPI is much less than it would have been in the early 80s, for example. That effect is going to come back into play.
Yeah. I'm waiting for the moment where he basically shows his cards. He came in with a very hawkish stance. Markets reacted. A lot more hawkish than I think people are anticipating, given the nomination from the White House on his way to there. But there will become a moment where he is forced to reverse course and do exactly the same thing that they always do. Try to save face. Save the dollar, save the economy, print something. And if we think about in the last 20 years, Brien, about what they have done to get us to this point, and if something breaks and maybe the market crashes, and given the hyper-financial, not crashes, let's not even put like complete, a terrible situation, but let's just say we get into a bear market where it just continuously drops lower and lower precipitously over a few months. the economy is so hyper-financialized, they will try to save it.
Oh, absolutely. And, there's two ways to look at it. One is if there is not a crisis, what does raising rates do? That tends to throttle the demand side of the equation on the economy, and that's not the problem we have. The problem we have, such as we have it, is the supply side of the equation. Higher rates only exacerbates that. So that's not going to really have an effect. He still has to go out there and talk a good game and look like he's diligent on inflation. So much of that was bluff and bluster in his first press conference that they're really going to focus on that. But again, he's just going to redefine things, and eventually he's going to lower rates because, as we say in the South, you dance with the one that brung you. And Trump brung him to the party, and he was going to dance the dance for Trump. I thought it was notable that after that first press conference, when he came out so hawkish and don't count on rate cuts anytime soon, et cetera, we didn't hear a peep out of Trump. He is not one known to hold his tongue.
Yeah.
So I think that was all pre-approved and pre-arranged. And, wink, wink, nudge, nudge, I'm going to come out and I'm going to say this, but don't worry, we're going to have an easier money policy. He's going to lower rates no matter what happens, even if something really bad doesn't happen. But if we do have that long-awaited, correction crash in this overblown stock market, if we have some kind of a liquidity event, they are going to have to do something that completely overshadows anything they did before. The great financial crisis, it took them 4 to 5 years to get rates to zero, to do quantitative easing, to do all of this stuff. When COVID hit, they did all of that in 4 to 5 days. And they had to deliver shock and awe to the markets to convince them that they were going to rescue the economy, rescue everything. The next time they're going to have to do so much more to deliver that same shock and awe because the patient has developed a tolerance for the drug.
Yeah.
You have to increase the dosage. They're going to blow your socks off of what they do in the next liquidity event.
I remember, great financial crisis, 08, 09. By the end of it, they had printed just under $1 trillion. It was like 900 billion, I think.
Yeah.
I can remember the exact number off the top of my head. It was somewhere around there. COVID, what was it, 7 trillion?
Yeah, got it up to almost 9 trillion on the balance sheet.
Okay, what next?
Yeah.
I mean, what's going to make 9 trillion look like child's play?
Yeah.
What number?
And you look at the trajectory of the debt. I mean, we have to pay for a lot more missiles, it's just one aspect of that. And it looks like we're going to have to pay for some more. But the debt, somebody posted, Craig Hemke posted on X the other day, that the deficit was like $350 billion or something in May. And I reposted it and said, annualize this. I dare you to annualize this and sell gold. And our deficit, I did annualize it, and that shows a deficit of about $3.5 trillion for this year. That doesn't account for the missiles that we're going to have to pay for, hundreds of billions and everything else to restock, and a number of other things that are off budget. The trajectory of the growth in debt is only getting larger, and at these interest rates, it's already unmanageable. We're already paying $1.2 trillion on top of that budget deficit just to pay the interest. And as I say, don't worry. They're never going to run out of money. They're just going to make more. That's the trajectory. That's the underlying big picture fundamental that has everybody walking around this conference gleefully unconcerned about today's sell-off.
Is that the catalyst for gold's clarity, next move higher, do you think?
I think it's been the underlying story all along, and it's the one thing we can get back to console ourselves on days like today when we're speaking and everything's selling off.
Yeah.
The two factors that have created this correction in gold have been Warsh's appointment, a fear of a suddenly hawkish Fed, and the U.S.-Iran war.
Yeah.
Both of those are going to get resolved eventually.
Let's talk about something easy, the Iran war.
Oh, yeah. Yeah.
Let's hash this out. I do think, and I asked Grant Williams this in our previous conversation. I kept on. He mentioned, and we've talked about it. The U.S. freezing Russian assets after their invasion of Ukraine, 2021. How that was really a huge moment in financial history that probably caused more distrust in the U.S. financial system, but the U.S. global power than it probably benefited anything. But if you fast forward to what we've been seeing in Iran and the Strait of Hormuz, is there a linkage that we're continuing to notice, a theme of mistrust that it continues to follow us into the Middle East? And what is the ramifications that we're maybe not yet appreciating?
Well, I think the obvious ramification of the Russian sanctions is that even our allies said, this is great, that's a powerful weapon, we're glad you're our friend, and I'm not going to say that word on the air. That gun could be turned on us at some point. I think it's notable that in the U.S. action against Iran that there were no allies jumping to help our cause. I mean, other than Israel. And, there was silence. And whenever Trump asked for some help, maybe in the Strait of Hormuz, et cetera, where the battle or the conflict is asymmetrical, which we don't do well with that sort of a thing. I think Trump is erratic, and I think that helps us in a lot of cases in the U.S. It helps in negotiations. And over the long term, it maybe doesn't a bit, and it doesn't create friends. Although geopolitics is all about power. Sometimes people enjoy when you're at the wrong end of the conflict. So, I think that is one of the issues that creates an uncertainty that has people and institutions and even sovereigns moving more toward gold. Obviously, they moved into gold rapidly after the Russian sanctions, but I think they also have their eyes on the debt and deficits, and that is an underlying factor why they're trying to diversify into gold.
Yeah. Let's talk shop here in the mining market. Obviously surrounded by a number of companies here in the exhibit hall at the Rules Symposium. What's your thoughts here on, we've had a pretty serious sell-off since the end of January when we were met with absolute froth and stars in our eyes.
Yeah.
And we go to Vancouver Resource Investment Conference, and shortly after that, c'est la vie is all said and done with. But even with gold at $4,000, miners continue to have incredible margins. Market doesn't necessarily fully appreciate that, but we're talking our own book here, right? But what does this sector need for, if you're talking on the explorer side or the developer side? Do we just need a higher gold price to get more interest in this, or do we need a little bit more internal activity such as M&A?
Well, back in January, I was telling people that if we have a 25% correction in the market, we'll be back to $4,000 gold, and that ain't bad. Apparently, I talked too loudly about that, and it went from my lips to God's ears, because that's exactly what happened. But it ain't bad. $4,000 gold is great for the miners. They're making a lot of money. But the market, which again is now driven by Western traders setting the price, they don't care where the price is. They just care where it's going. Yeah. And until we get that arrow pointing up consistently in gold, they're not going to come back. In the meantime, though, as you mentioned, the big producers are making so much money. They're paying off their debts, and not too much longer, they're going to have they're going to be debt-free with nothing more to do with their money. Well, they'll have three options: pay richer dividends, buy back stock, buy projects. Yeah. And they will have to put that money on their books.
I'd say they've already seen two of those three.
Yeah.
Dividends, and although I will say it's nice to have the dividends, but it's always kind of like, well, that's nice, but it's like it might buy a beer at the.
Yeah.
It might be enough to buy. I'll buy the first round, but
mining stocks are not growth companies. They're not. They are timing the products. timing mechanisms. You have to get in at the right time, but you have to get out at the right time. The fact that Barrick, not too recently, hit its high from 20 years ago on share price tells you that these are not growth investments that you just sock away for the long term. You got to get in and out. And so, yeah, buying back stock, getting dividends, it's a 1-year horizon, 2-year horizon where you're in a good investment. You're really in a mining stock for capital gains.
Yeah.
And that's what I think they're going to deliver. But those capital gains are going to go down the food chain down the road. I don't know whether it's going to be next month or next year. But they're going to have so much money burning holes in their pockets that human nature is going to kick back in. They're going to start spending like drunken sailors once again, because it happens every cycle. And you're going to want to own the juniors that have outstanding projects at that point in time.
I do really like the royalty space here.
You can't not like it, yeah.
I don't know anything. I can't think of a single thing that would go against it. Given the margins of producers, the challenging acquiring new royalties is just getting more and more expensive.
Yeah.
If you are cashed up or have a reasonable cost of capital, those are about the only ones that can go in there and actually acquire these portfolios anymore, because they're just getting more and more expensive, right?
Yeah.
But creatively on this side, we are seeing a number of junior companies, prospect generators or the like, who are taking that Great Bear play card and producing a royalty on their own project, knowing they're not the ones that are going to take it into development, but they can add some value for their shareholders by spending a royalty position out for them. But even those are getting really expensive when it comes to acquisition, right?
Yeah, you have to have the right project to do that. Great Bear had it, Vizsla Silver has it. If you have the right project, it's genius, and that was a genius move by Great Bear. I wish they wouldn't have sold it. I wish they would. I was looking at that as a legacy for my kids, but yeah, that worked out well. It's a great way, but it takes a special project. And for royalty companies, you have to find a niche. You have to find a differentiator. You have to be close to production, have production. You got to find a niche in the market that the big ones aren't in or the small ones can't reach to, etc. But it's hard to create a new royalty play that has a distinct advantage today. But royalty plays that already exist offer the advantage of instant leverage to the gold price, without the commensurate risk of an operating company.
How about some of the current companies you're keeping a close eye on? Can you share some insights? Which ones any news stories you're really interested in?
I would have looked at my personal portfolio before I came on the air if you would have said that. But
we all have our favorites.
We all have our favorites. But reaching into the recesses of my fading memory, I am excited about Prospector Metals because it has been our top pick for a couple of years now and had a big discovery.
Okay.
Really, high impact drill program going on now. We'll have to see if they can follow up on it. Great team, etc. I think K2 Gold is another one that has a high impact drill program right now. Both of these companies are, in this market relatively highly valued, so you have to have success. But I think they have very high likelihood of success as well. There are a couple of companies that I've found that have one that's just getting ready to come onto the markets. I won't mention that yet. Another one, Northern Lights, that is very small market cap, very early, a very high risk exploration play because it has a couple of projects in it brought in by Bernie Kreft that he's excited about.
Yeah.
They sold a royalty, so with like a $6 or $8 million market cap, they had about $3 million in the bank and are putting a couple $1 million into exploration and drilling this season. That has a kind of leverage that's uncommon in this market for an exploration play. Yeah. But that is a high-risk drill hole play.
Very good. All right, and obviously more of this type of discussion in New Orleans.
Yes, and I should mention, obviously, also I own all three of those stocks.
If it wasn't already obvious.
If it wasn't already clear. But yes, New Orleans is going to be a blockbuster event this year. We are unsurprisingly focusing on metals and mining, although we cover all the markets and lots of macro. We have one of our best rosters ever of experts and speakers. I can think of no other reason more important than the fact that you're going to be there.
For the first time.
For the first time. I cannot believe that's the first time.
Isn't that crazy? It's just always come up. It's just always battled with some personal reason, like with the family or whatnot. I just never could make it happen. But this year, it's like, you know what? I'll be around.
Unfortunately, I think all the football teams are away that weekend. I would have loved to have brought you to Tiger Stadium and made it.
Oh, you know what I love about this World Cup and everything that happened with the Balogun red card situation is like the Europeans don't even understand. We've been living with the SEC like this forever.
Oh yeah, absolutely. And the X post by SEC Letterman, a 3-year Letterman, it's hilarious.
Well, it would be fun. I do want to go to Tiger Stadium. The amount of money in that department, that football program right now is just unfathomable.
And I'm so happy. As you can see, audience can't, but I've got an ear-to-ear grin because you're talking about my team.
I know.
The cathedral of college football. I've got to get you there.
Yeah, all right. Well, we're going to make it happen. I'm going to go visit LSU. You're going to come up to Lincoln and go to a Nebraska game.
I would love that.
We're going to make it happen eventually.
Yeah.
And there's actually I just visited, there's actually an exploration play outside of Lincoln now, so we can get a little work done and have a little fun, a little football Saturday.
Okay. I know of at least one company that I've followed for years.
Yeah, I'll fill you in on that one.
Okay.
All right, Brien, thanks so much. Join us if you are willing and able in New Orleans the last week of October for the New Orleans Investment Conference. I promise you it'll be a good time, better than ever, because I'll be there partying it up with Brien Lundin here. Good to see you, man.
Thank you.
The information presented should not be considered investment advice. Mining Stock Daily and its affiliates are not responsible for any loss arising from any investment decision in connection with the material presented herein. Please do your own research or speak with a licensed financial representative before making any investment decisions.